The most dangerous moment in trading is not when you lose one trade, it is when you lose again and again and again until you start questioning everything you thought you knew. Your strategy, your judgment, even yourself. You tell yourself, I just need one good trade to get it back. So you enter again. You risk more, you force opportunities that are not really there. And suddenly, the market is no longer testing your strategy, it is testing your mind. But here is what separates profitable traders from everyone else. They do not treat a losing streak like a disaster. They treat it like information. In this video, you will discover what they do immediately after consecutive losses, how they stop revenge trading before it destroys their account, why stepping away can sometimes be the smartest trade, how they rebuild confidence without increasing risk, and the uncomfortable truth about why losing streaks often expose weaknesses that winning streaks hide. Because the goal is not to avoid losing. The goal is to become the kind of trader who cannot be destroyed by it. And once you understand what happens inside a profitable trader's mind during a losing streak, you may never look at your losses the same way again. Chapter 1. The first loss. Stay calm. The first loss usually does not hurt because of the money. It hurts because of what the loss seems to mean. You look at the screen and see red numbers. Your trade failed, your prediction was wrong. For a moment you feel that small pressure in your chest. Then your mind starts asking questions. Did I enter too early? Did I miss something? Should I have waited? This is where the real battle begins. Not on the chart. Inside your mind. A profitable trader understands something that most traders learn only after years of painful experience. One losing trade means almost nothing. It is simply one result. But the way you react to that result can change everything that happens next. You can accept the loss, study it, and move forward. Or you can let one loss become 2, then 3, then 5. The first loss is not the danger. Your reaction to the first loss is the danger. Imagine you take a trade based on your plan. Everything looks right. Your setup appears. You enter. Then the market moves against you and hits your stop. Your account is slightly smaller. You feel frustrated. You think, this should have worked. That sentence sounds harmless, but it can become dangerous. Because underneath it is a hidden belief that good analysis should always produce a winning result. It does not. The market does not reward you because you followed your rules. It simply gives you an outcome. Sometimes you win, sometimes you lose, sometimes the exact same setup works beautifully one day and fails completely the next. A professional trader knows this. A struggling trader fights it. He wants the market to confirm that he was right. When it does not, his ego becomes involved. Now the next trade is no longer about following the plan. It becomes about proving something. This is where calm becomes a trading advantage. Staying calm does not mean you feel nothing. You may still feel disappointed. You may still feel frustrated. You may even feel angry. The difference is that you do not allow those emotions to make decisions for you. You notice the emotion, but you do not obey it. That is a powerful distinction. You can say, I am frustrated, without saying, therefore, I need another trade. You can say, I want to recover this money without immediately risking more money. You can feel the urge to enter again and still choose to wait. That is discipline. And discipline often looks very boring from the outside. There is no dramatic comeback, no huge trade, no emotional victory, just a trader sitting quietly accepting what happened and refusing to make the situation worse. Let me tell you something. The first loss is often a test of identity. If you believe you must be right, a loss feels personal. If you believe your job is simply to execute well, a loss becomes part of the process. That shift changes everything. Profitable traders do not measure themselves by individual trades. They measure themselves by the quality of their decisions over many trades. They understand probability. They understand uncertainty. Most importantly, they understand that a single outcome cannot tell the whole story. A coin can land heads several times in a row without changing the probability of the next flip. Trading works with the same uncomfortable reality. Your last trade does not owe you a winning trade. Your next trade does not exist to repair your last trade. And this is where many traders make their first serious mistake. They lose once, then immediately search for another opportunity. Not because the setup is strong, but because they want relief. They want to feel better. They want the account balance to return to where it was. They want the uncomfortable feeling to disappear. But trading for emotional relief is one of the fastest ways to lose control. The market becomes your emotional escape. You stop asking, is this a good trade? And start asking, can this trade make me feel better? Those are completely different questions. A profitable trader handles the first loss differently. He pauses, He breathes, he looks at the trade without emotion. Was the setup valid? Did he follow his rules? Was the risk controlled? If the answer is yes, he accepts the result. If the answer is no, he studies the mistake. Either way, he does not immediately chase another trade, because he knows something most beginners ignore. The next decision matters more than the last result. One loss does not define you. One loss does not prove your strategy is broken. One loss does not mean the market is against you. It is simply one moment in a much larger game. But if you cannot stay calm after one loss, what happens when the losses start coming faster? What happens when confidence begins to disappear? What happens when the red numbers are no longer a small inconvenience, but a growing emotional weight? That is where the real test begins, because the first loss only knocks on the door. The losing streak is what comes through it. Chapter 2. When losses start to pile up, one loss is easy to accept. 2 losses make you uncomfortable. 3 losses can make you question your entire approach. This is where the mind begins to change. You stop seeing each trade as a separate event and start connecting everything together. You look at the account balance and think about the money you have already lost. You remember the winning trades you had before the streak started. Then a dangerous thought appears. I need to make it back. That thought feels natural, but it can quietly destroy your discipline. The moment you become focused on recovering what you lost, you stop focusing on what the market is offering right now. Your attention moves from opportunity to recovery, from process to outcome, from discipline to emotion. A losing streak can make even an experienced trader feel small. You can follow your plan and still lose. You can take a clean setup and watch it fail. You can do everything correctly and still see your account move in the wrong direction. That is difficult because human beings naturally want a clear connection between effort and reward. If you work hard, you expect results. If you make a good decision, you expect a good outcome. But the market does not work that way. Good decisions can produce losses. Bad decisions can sometimes produce profits. That is one of the hardest truths in trading. A trader can break every rule and make money. Another trader can follow every rule and lose money. The difference becomes clear only over a large sample of trades. Profitable traders understand this reality. They do not judge their entire ability from a few painful outcomes. But when losses pile up, the brain does not think statistically, it thinks emotionally. After the third loss, you may not remember the 20 trades before it. You remember the 3 losses. They become louder than everything else. Your mind starts searching for a reason. Maybe the market has changed. Maybe your strategy stopped working. Maybe you need a new indicator. Maybe you need to increase your position size. Maybe you should trade a different market. Suddenly, instead of examining your behavior, you start changing everything around you. This is often how confusion begins. The trader keeps changing the strategy when the real problem is the reaction to the losses. There is another dangerous feeling that appears during a losing streak. The desire to prove yourself. You start thinking, I know I can do this. That sounds like confidence, but sometimes it is wounded ego wearing the clothes of confidence. You want the next trade to prove that you are still a good trader. You want the market to give you a victory. You want to look at the chart and say, see, I was right. But the market does not care about your pride. It does not know your history. It does not know how much you lost yesterday. It does not know how badly you want to recover today. Every new setup begins without emotion. The market is not trying to punish you. It is simply moving. This is why profitable traders separate losing streaks into 2 questions. The first question is, are my losses normal? The second is, am I making mistakes because of the losses? Those questions are completely different. A strategy can naturally experience a series of losing trades. That does not automatically mean something is broken. But if the trader starts increasing risk, entering late, moving stops, taking random setups, or trading out of boredom and frustration, then the problem is no longer just the losing streak. The trader himself has become part of the problem. And this is where emotional control becomes more important than market prediction. You cannot control whether the next trade wins. You can control how much you risk. You can control whether you follow your rules. You can control whether you take a break. You can control whether you enter a trade because the setup is valid or because you desperately want to recover. That is where your power exists. Profitable traders protect that power. Sometimes the strongest move after several losses is to do nothing. Close the platform, walk away from the screen, let the emotional pressure fall. Not because you are weak, but because you understand that a damaged mind makes expensive decisions. When your judgment becomes clouded, more screen time does not always create more clarity. Sometimes distance creates clarity. The market will still be there tomorrow. Another setup will come. Another opportunity will appear. You do not need to force one into existence. The deeper lesson is simple. A losing streak does not automatically destroy a trader. The story the trader tells himself about the losing streak can. If you believe the losses mean you are a failure, you will trade from fear. If you believe you must recover immediately, you will trade from greed. If you believe the market owes you a win, you will trade from anger. But if you see the losing streak as information, you create space to think. You can ask what is normal, what needs improvement, and what needs to stop. That is when the emotional storm begins to lose its power. But there is still a trap waiting for you. Because once the pain becomes strong enough, the trader often stops trying to understand the market and starts trying to fight it. And when that happens, the next decision becomes far more dangerous than the loss that started everything. Chapter 3. Stop chasing the market. The moment you stop accepting a loss, you start chasing the market. It can happen quietly. You take a loss, stare at the chart, and tell yourself, I can get this back. You see another setup forming and enter quickly. Maybe the setup is not perfect, but you convince yourself it is close enough. The trade moves against you again. Now the frustration becomes stronger. You tell yourself, I cannot finish the day like this. So you enter again. This time you are no longer trading the market. You are chasing your money. And there's a huge difference between those two things. A profitable trader knows that the market does not need to give back what it took. The market owes you nothing. Your only responsibility is to make the next decision correctly. Chasing usually begins with a simple emotional mistake. You start looking backward instead of forward. You keep thinking about the money that disappeared. You remember the exact moment you could have exited. You imagine what would have happened if you had taken another setup. Your mind creates an alternate version of reality where you are profitable. Then you try to force the current market to recreate that imaginary result. But the market is not connected to your memory. It does not care about yesterday's mistake. It does not care about the trade you wish you had taken. The chart in front of you is the only reality that matters. Profitable traders understand this. They do not ask the market to repair their emotions. They ask one simple question: is there a valid opportunity right now? That question can save you from a lot of damage, because when you are calm, you can see the difference between an opportunity and an excuse. An opportunity exists because your rules say it exists. An excuse exists because you want to trade. During a losing streak, those two things can look almost identical. Your brain becomes very creative when it wants relief. A small movement suddenly looks like a breakout. A weak setup suddenly looks like a perfect entry. A random price movement suddenly feels like a signal. You are not seeing the chart clearly anymore. You are seeing what you want to see. This is confirmation bias mixed with emotional pressure, and it can turn a normal losing streak into a serious account problem. Let me tell you something. Revenge trading rarely feels like revenge when you are doing it. It feels like confidence. You tell yourself, I know what I am doing. You increase the size because you believe the next trade will work. You take more risks because you want the recovery to happen faster. You call it conviction. But sometimes conviction is simply impatience with a better name. Real confidence does not need urgency. Real confidence can wait. Real confidence can take a loss and remain calm. Real confidence can watch a perfect-looking setup disappear without jumping into the market just because it was available. This is where profitable traders become different. They do not try to win every battle. They understand that trading is a long game. Missing one trade is not a disaster. Taking a bad trade can be. That distinction changes their behavior. They would rather miss an opportunity than enter a trade that does not meet their conditions. Why? Because they know opportunities are unlimited. But capital is limited. Their account is their ammunition. They protect it because they understand that survival comes before growth. You cannot compound an account you constantly damage. Imagine two traders after 3 consecutive losses. The first trader becomes desperate. He says, I need a win. He searches every chart. He increases his risk. He enters trades that he normally would ignore. The second trader closes the platform for a moment. He reviews the trades. He checks whether he followed his plan. If he did, he accepts the losses as part of probability. If he did not, he identifies the mistake. Then he waits. Same market, same losses, completely different response. One trader is trying to control the outcome. The other is controlling himself. That is the real battle. You cannot control the next candle. You cannot control whether buyers or sellers appear. You cannot control whether your setup succeeds. but you can control whether you chase. You can control whether you increase risk. You can control whether you walk away when your emotions become too strong. Every time you refuse to chase the market, you strengthen your discipline. Every time you chase it, you teach your brain that emotional discomfort should be solved with another trade. And that lesson becomes dangerous very quickly. Eventually, the market will give you another opportunity. Maybe it will come in an hour, maybe tomorrow, maybe next week. You do not need to force it. Your job is not to make something happen. Your job is to be ready when something worth taking appears. That sounds simple, but living by it requires emotional strength, because the market will constantly tempt you to act when you should wait. It will show you movement and make you feel like you are missing out. It will make you believe that one more trade can change everything. But the trader who survives a losing streak learns a deeper lesson. Sometimes the most profitable decision is not an entry, it is restraint. And once you learn to stop chasing the market, another battle begins. You must learn how to control the emotion that remains after the screen goes quiet, because even when you stop trading, the fear of losing can still control you. Chapter 4. Control your emotions before your trades. The screen is quiet, but your mind is not. You have stopped chasing trades. You have stepped away from the chart, yet the loss is still sitting inside your head. You remember the red number. You replay the entry. You imagine what you should have done differently, then a new thought appears. What if I lose again? This is where many traders misunderstand emotional control. They think being disciplined means becoming emotionless. It does not. You will feel fear. You will feel frustration. You will feel disappointment. Sometimes you will feel anger. The goal is not to remove those emotions. The goal is to stop those emotions from becoming your decision maker. Think about what happens before a trade. You see your setup. Normally you would study it calmly. But after a losing streak, the same setup can look completely different. Your brain remembers the pain. It whispers, "Be careful." Then another voice says, "You cannot afford another loss." You hesitate. You enter late. You move your stop, you reduce your size for the wrong reason. Or you avoid a valid setup completely. The market has not changed. Your emotional state has changed. That is why profitable traders pay attention to their mindset before they pay attention to the chart. They know that the same strategy can produce completely different decisions depending on the person executing it. Fear is especially powerful because it can disguise itself as intelligence. You may tell yourself you are being cautious when you are actually afraid. You may say, "I am waiting for confirmation," when deep down you are terrified of another loss. There is nothing wrong with being cautious, but there is a difference between thoughtful patience and emotional hesitation. Thoughtful patience follows a plan. Emotional hesitation changes the plan because of fear. A professional trader learns to recognize that difference. He does not ask, "How do I feel about losing?" He asks, "What does my process require right now?" The same thing happens with confidence. After a few losses, you may try to rebuild confidence by taking a bigger trade. You think a large win will make you feel like yourself again. But that is not confidence. That is emotional dependence on the outcome. Real confidence is quieter. It comes from knowing that you can follow your rules whether the trade wins or loses. You do not need the next trade to prove anything. You do not need to recover immediately. You do not need the market to make you feel successful. Your confidence comes from knowing that you can remain disciplined under pressure. This is where self-awareness becomes a trading skill. Before entering a trade, you should be able to recognize what is happening inside you. Are you calm? Are you trying to recover? Are you afraid of missing the move? Are you angry about the previous loss? Are you entering because the setup is valid or because you want action? These questions may seem simple, but they can expose the real reason behind a trade. Sometimes the chart says wait, but your emotions say do something. Profitable traders learn to listen to the chart without being controlled by the emotion. Let me tell you something important. You do not have to feel confident to act with discipline. You can be nervous and still follow your plan. You can feel uncertain and still respect your risk. You can be disappointed and still walk away. Emotional strength is not the absence of discomfort. It is the ability to carry discomfort without allowing it to control your behavior. That is a completely different kind of strength. During a losing streak, your biggest enemy may not be fear itself. It may be your desire to escape fear. You want the next trade to remove the uncomfortable feeling. You want a green candle because green makes you feel safe. You want a winning trade because winning tells you that everything is okay. But if your emotional state depends on the last trade, you will always be vulnerable. One win will make you overconfident. One loss will make you afraid. One missed opportunity will make you impatient. Your emotions will rise and fall with every candle. Profitable traders build something stronger. They create a separation between their feelings and their actions. They can say, I feel afraid, but my rules have not changed. They can say, I want to recover, but this is not a valid setup. They can say, I am frustrated, so I am done for the day. That last sentence can be incredibly powerful. Knowing when to stop is not weakness. It is risk management for your mind, because your trading account is not the only thing that can suffer during a losing streak. Your confidence can suffer, your patience can suffer, your ability to trust yourself can suffer. And once that happens, even a good strategy can become difficult to execute. This is why emotional control must come before the trade, not after it. You do not wait until you are already underwater to learn how to swim. The market will continue to test you. It will test your patience when nothing happens. It will test your confidence when trades fail. It will test your discipline when you see an opportunity you desperately want to take. But every time you pause before reacting, you are training the most important part of your trading system, yourself. And once you learn to control your emotions before the trade, you face an even deeper challenge, rebuilding your confidence without becoming desperate to prove that you are still a winning trader. Chapter 5. Protect your confidence during a losing streak. Confidence can disappear quietly. You may not notice it after the first loss. You may still feel normal after the second. But after several losses, something changes. You look at the next setup and hesitate. You question your entry. You doubt your strategy. You hear a voice inside your head saying, what if this one loses too? And now the problem is bigger than money. You are beginning to lose trust in yourself. This is one of the most dangerous stages of a losing streak, because a trader without confidence can make poor decisions even when the strategy is sound. You stop trusting your process, then you start searching for something else to trust. A new strategy, a new indicator, a new market, a new system. Anything that promises certainty, but certainty is exactly what trading cannot give you. Understand this. Confidence should never come from winning every trade. If it does, your confidence will always be fragile. One loss can break it. One losing streak can destroy it. Real confidence comes from knowing that you can handle uncertainty without abandoning your discipline. You do not need to know what the next trade will do. You need to know what you will do if it goes against you. That is where real confidence begins. It is not the confidence of someone who believes, I will win. It is the confidence of someone who knows, whatever happens, I will follow my rules. Think about the difference. A weak form of confidence says, this trade is definitely going to work. A stronger form says, this is a valid setup and I accept the possibility of losing. The first statement is built on prediction. The second is built on preparation. One depends on being right. The other depends on being disciplined. Profitable traders choose the second. They know that trying to predict every outcome creates unnecessary emotional pressure. They are not trying to become perfect. They are trying to become consistent. During a losing streak, your mind will want proof that your strategy still works. You may start looking at old winning trades. You may scroll through charts searching for examples. You may even change your rules because the current results are uncomfortable. But this is where patience matters. A losing streak can make normal variance look like failure. If your strategy has always experienced periods of losses, then the existence of a losing streak alone does not prove the strategy is broken. You need evidence. You need review. You need data. Most importantly, you need a clear head before making major changes. This is why profitable traders separate confidence from ego. Ego says, I need to prove that I am right. Confidence says, I know what I can control. Ego wants the next trade to erase the previous loss. Confidence accepts that the previous loss is finished. Ego becomes louder after failure. Confidence becomes quieter. Ego demands action. Confidence allows patience. That difference may look small, but over hundreds of trades, it can create a completely different outcome. There will be moments when you feel like you have lost your edge. You will question whether you still have what it takes. You may even compare yourself to other traders who seem to be winning while you are struggling. You see screenshots of profits. You hear stories about big wins. You wonder, why is everyone else succeeding while I keep losing? But you rarely see the full picture. You do not see their losing days. You do not see their mistakes. You do not see the trades they walked away from. Comparing your hardest moment to someone else's best moment will only damage your focus. Instead, rebuild confidence through small promises you can keep. Follow your risk limit. Take only valid setups. Stop when your rules tell you to stop. Review your trades honestly. Sleep well. step away when your mind becomes emotional. These actions may feel insignificant compared with making a huge profit, but they rebuild something much more important: trust. Every time you keep a promise to yourself, you prove that you can be trusted under pressure, and when that trust grows, confidence returns naturally. You do not need one massive winning trade to rebuild yourself. You need a series of disciplined decisions. Maybe the next trade wins. Maybe it loses. Either way, your job remains the same. Execute properly, accept the outcome, learn, continue. That is how confidence becomes stable. It stops depending on green numbers and starts depending on your behavior. The strongest traders are not the ones who never doubt themselves. They are the ones who know how to move through doubt without letting it control them. They understand that confidence can bend without breaking. They can lose money and still respect their process. They can have a bad week and still return with discipline. They can experience uncertainty without desperately searching for certainty. And there is something else you must understand. Sometimes confidence does not return because you keep trading. Sometimes it returns when you stop. There comes a point during a losing streak when more screen time does not create more opportunity. It creates more emotional noise. That is when the smartest decision may be to step away, reset your mind, and return only when you can think clearly again. Because the next stage of becoming a profitable trader is not learning how to trade through every losing streak. It is learning when to step back before the losing streak changes who you are. Chapter 6. Know when to step back. Sometimes the bravest thing a trader can do is close the platform. No more charts, no more candles, no more searching for the perfect setup. Just silence. For a trader who has been losing, that silence can feel uncomfortable. You may think, what if I miss the next big move? What if the market turns around right after I leave? But profitable traders understand something that emotional traders often forget. There will always be another opportunity. Your capital needs protection, but so does your mind. When your judgment becomes clouded, staying in the market simply because you feel you must recover can turn a temporary losing streak into a much bigger problem. A losing streak does not always mean you should stop trading. Sometimes losses are simply part of your normal probability, but there is a difference between experiencing losses and losing control because of them. The warning signs usually appear before the account damage becomes serious. You start checking your P&L constantly. You become angry at small price movements. You move your stop because you cannot accept being wrong. You enter trades outside your normal hours. You increase your position size because you want to recover faster. You stop following the rules that worked for you before. These are not simply trading mistakes. They are signs that your emotional state is beginning to control your behavior. This is where stepping back becomes a form of discipline. Walking away does not mean you are giving up. It means you are refusing to make decisions from a damaged state of mind. Imagine a professional athlete who knows that exhaustion is affecting performance. He does not keep pushing simply because the game is still happening. He recognizes the condition and adjusts. Trading requires the same awareness. You need to know when your mental energy is too low, when frustration is too high, and when your desire to recover has become stronger than your ability to follow your plan. Let me tell you something. The market will still be there when you come back. That one sentence can change your relationship with trading. You do not need to catch every move. You do not need to trade every day. You do not need to recover your losses today. The market creates thousands of movements, but only a small number need to become your trades. Profitable traders are selective because they understand that opportunity is not the same as obligation. Just because the market is moving does not mean you need to participate. Stepping back also gives you something that cannot be found by staring harder at a chart: perspective. When you are inside a losing streak, every loss feels connected to the next. 1. Your mind creates a story. Nothing is working. I always lose when I enter. Maybe I am not good at this. But after stepping away, the story often becomes smaller. You can look at the trades without the same emotional weight. You may realize that some losses were normal. You may notice one repeated mistake. You may see that your strategy was fine, but your execution changed. Distance creates space between the event and your reaction. That space is valuable. In that space, you can review instead of react. You can ask whether your losses came from the strategy, the market conditions, or your own behavior. You can look at your journal. You can compare your recent trades with your normal execution. You can identify patterns. Maybe you were entering too early. Maybe you were taking lower quality setups. Maybe you were risking more after losses. Maybe you were trading when tired or distracted. These insights are difficult to see when your only goal is to make the money back. And there is another reason stepping back matters. Your brain needs time to break the emotional connection between loss and action. If every painful feeling immediately leads to another trade, your brain learns that trading is the way to escape discomfort. That creates a dangerous habit. Loss creates anxiety. Anxiety creates action. Action creates another loss creates more anxiety. The cycle continues. Stepping away breaks the pattern. You feel the discomfort without trying to solve it with another position. That is psychological strength. Some traders believe taking a break means they are weak. They think strong traders keep going. But that is ego talking. Strength is not always pushing forward. Sometimes strength is recognizing when pushing forward is making things worse. A professional does not prove discipline by trading through emotional chaos. A professional proves discipline by protecting the quality of future decisions. You may lose an entire day of trading by stepping back, but you could protect months or years of progress by doing it at the right moment. One missed opportunity is small compared with the cost of emotional trading. There will be another chart, another setup, another session, another chance to execute properly. The goal is not to avoid every losing streak. That is impossible. The goal is to prevent a losing streak from becoming an identity. You are not your last trade. You are not your last week. You are not your account balance on one difficult day. You are a trader learning how to operate under uncertainty. And sometimes learning means knowing when to stop, breathe, review, and return with a clearer mind. But stepping away is only the beginning. Eventually, you have to come back to the market, and when you do, you cannot simply pretend the losses never happened. You need to understand them. You need to turn the pain into information. Because the trader who learns nothing from a losing streak is almost guaranteed to repeat it. Chapter 7. Learn from the losing streak. A losing streak can either become a scar or a lesson. The difference is what you do after the pain becomes quiet. When the charts are closed and the emotional pressure begins to fade, you finally have a chance to look at what actually happened. Not what you felt happened. Not what you wish had happened. What really happened. This is where profitable traders become investigators instead of victims. They do not sit there asking, why does this always happen to me? They ask better questions. Were these losses normal? Did I follow my rules? Did the market change? Did my behavior change? Those questions turn frustration into information, and information is where improvement begins. Most traders review losing trades emotionally. They open the chart and immediately search for the mistake. They look at the entry and think, I should have waited. They look at the exit and think, I should have held longer. They look at the winning move that came later and think, if I had stayed in, I would have made money. But this kind of review is dangerous because it judges the trade using information that was only available afterward. Profitable traders try to review the decision based on what they knew at the moment they entered. That is a completely different standard. The question is not, did the trade win? The question is, was this a good decision with the information I had? Imagine you take 5 trades during a difficult week. 4 lose. Your first reaction might be, my strategy is terrible. But then you review the trades carefully. You discovered that 3 of the losses followed your rules exactly. 1 was a valid setup that simply failed. The 4th loss happened because you entered late after feeling impatient. Now the picture changes. The problem may not be the strategy. The problem may be one behavior. Without reviewing the trades, you might throw away a system that was working and replace it with something worse. One losing streak could have pushed you into unnecessary change. Data protects you from emotional conclusions. This is why journaling can become one of the most powerful tools during a losing streak. You do not need a complicated system. You need honesty. Write down what you saw, why you entered, where you placed your risk, what happened, and most importantly, what you were feeling. Were you calm? Were you trying to recover? Were you afraid of missing the move? Were you angry about the previous trade? Over time, patterns begin to appear. Maybe your biggest losses happen after 2 consecutive losses. Maybe you take weaker setups late in the day. Maybe you increase risk when your emotions try to hide. And this is where the losing streak becomes valuable. It shows you the version of yourself that winning trades can hide. When you are winning, discipline feels easy, patience feels natural, risk management feels obvious. But when you lose, your real habits appear. Do you respect your stop? Do you follow your plan? Do you become impatient? Do you need to be right? Do you start chasing losses, expose these weaknesses because they create pressure? They show you exactly where your discipline becomes fragile. Understand this. Learning from losses does not mean finding someone or something to blame. You do not blame the market. You do not blame the news. You do not blame the strategy. For every outcome, you take responsibility for what you can control. That does not mean every loss was your fault. It means every loss can teach you something if you are willing to examine it honestly. Sometimes the lesson is that you executed perfectly and the trade simply failed. That lesson matters too. It teaches you to accept uncertainty. Profitable traders also look for repeated patterns instead of isolated mistakes. One bad trade may be random. 5 similar mistakes may be a system. If you repeatedly enter too early, that is not bad luck. If you repeatedly increase your risk after losses, that is not bad luck. If you repeatedly abandon your rules when frustrated, that is not bad luck. These patterns are signals, and once you can see them, you can change them. The goal of reviewing a losing streak is not to make yourself feel guilty. Guilt creates emotion. Awareness creates change. You do not need to say, I am a terrible trader. You need to say, this behavior is hurting my results, so I need to change it. That shift is powerful because it separates your identity from your mistake. You made a bad decision. You are not a bad trader. You experienced a losing streak. You are not a losing trader. And eventually, something changes. The losses stop feeling like attacks. They become feedback. A losing trade says something about the market. A repeated mistake says something about your behavior. A long losing streak says something about your process, your strategy, or your ability to execute under pressure. You listen, you adjust, you become more precise. But there is one final challenge. After studying the losses, after understanding the mistakes, after stepping away and rebuilding your confidence, you still have to return to the market. And returning is where many traders make another mistake. They come back desperate to prove they have changed. They want a big win. They want to erase the memory of the losing streak immediately. But that is not how recovery works. You do not rebuild yourself with one massive trade. You rebuild yourself one disciplined decision at a time. And when that mindset finally becomes part of you, you are ready to come back differently. Chapter 8. Come back with discipline. There comes a morning when you open the charts again. The losing streak is behind you, but you can still remember how it felt. The frustration, the doubt, the temptation to recover everything quickly. You remember the trades that went wrong and the moments when your emotions almost took control. But this time, something is different. You are not returning to prove that you can win. You are returning to prove that you can stay disciplined. That difference may look small, but it can completely change the way you trade. A trader who returns looking for revenge is still trapped inside the losing streak. A trader who returns with patience has already started moving beyond it. The first thing you must accept is that coming back does not mean making your money back immediately. This is one of the hardest lessons for any trader. You may have lost $500, $1,000 or more, and your mind wants a specific number. It says, I need to recover this. But recovery should never become the objective of a trade. The market does not know your account history. It does not know how much you lost. It cannot see the number you're trying to recover. If you make that number your target, you will start forcing decisions that have nothing to do with opportunity. Your goal is not to recover yesterday. Your goal is to execute today correctly. This is where discipline becomes more powerful than motivation. Motivation tells you that you are ready to fight again. Discipline tells you to follow the process even when you do not feel ready. Motivation can disappear after one loss. Discipline can continue because it does not depend on emotion. A disciplined trader can take a small position when confidence is low. He can wait when there is no setup. He can accept another loss without changing his behavior. He can close the platform when his rules tell him to stop. These actions may not feel exciting, but they are what protect a trader over the long term. Your first trades after a losing streak should not be about proving anything. They should be about rebuilding trust. Think of it like repairing a relationship with yourself. Every time you follow your plan, you keep a promise. Every time you respect your risk, you keep a promise. Every time you refuse a random trade, you keep a promise. Slowly, your confidence starts coming back, not because you made a huge profit, but because you showed yourself that you can behave correctly under pressure. And this is the part most people underestimate. A profitable trader is not someone who has mastered winning. A profitable trader has mastered losing without destroying himself. He understands that losses are part of the business. He knows that even the best setup can fail. He knows that a losing streak can happen without warning. He also knows that his job is not to eliminate uncertainty. His job is to manage his response to uncertainty. That is why risk management matters so much. Small controlled losses give you room to think. Large emotional losses take away that room. When you come back, make your world smaller. Focus on one decision at a time. Do not think about the last 10 trades. Do not think about how much money you need to recover. Do not imagine what your account could look like at the end of the month. Look at the setup in front of you. Is it valid? Does it meet your conditions? Is the risk acceptable? If the answer is yes, execute. If the answer is no, wait. Simple decisions repeated consistently create results that emotional decisions cannot. There will still be fear. Do not expect it to disappear completely. You may feel nervous before the first trade. You may hesitate when the market moves against you. You may remember the losing streak when you see the first red candle. That is normal. Do not fight the feeling. Notice it. Then return to the process. You do not need to feel fearless. You need to behave correctly while fear is present. There will also be moments when you are tempted by confidence. Maybe you take 2 winning trades and suddenly feel like you are back. Your mind says, I have figured it out again. Be careful. A losing streak can create fear, but a quick recovery can create overconfidence. You increase your size, you take more trades, you loosen your rules, the cycle begins again. Discipline must remain the same when you are winning and when you are losing. Otherwise, you are simply moving between 2 emotional extremes. This is what makes a professional mindset different. The professional does not become a different person after a loss. He does not become reckless after a win. His behavior stays stable. His risk stays controlled. His standards stay clear. His identity is not attached to the last result. That stability creates consistency, and consistency creates the foundation for long-term profitability. So when the next losing streak comes, and it will come, remember what it taught you. Stay calm after the first loss. Do not chase the market. Control your emotions before you trade. Protect your confidence. Know when to step back. Study what went wrong, then return slowly with discipline. Because the ultimate goal is not to become a trader who never loses. That trader does not exist. The goal is to become a trader who can lose without losing control. A trader who can take a hit, learn from it, step away when necessary, and return with a clear mind. A trader who understands that one bad day does not define the future. And maybe that is the real secret behind profitable traders. They are not profitable because they always know what the market will do. They are profitable because when the market does something they did not expect, they do not lose themselves with it. They remain calm. They remain patient. They remain disciplined. And when everything around them becomes uncertain, they know exactly what they can control. The market, your money, your future. None of these are guaranteed. But your discipline can be a choice. And every time you make that choice, you become harder to break.